Quantitative easing. Sounds boring, right? Like something your accountant might mumble about while you're dozing off. But trust me, it's way more exciting than it sounds. Okay, maybe exciting isn't the right word. How about terrifying? Because QE is basically the economic equivalent of giving your sick friend a bunch of Red Bull and hoping for the best. So, what is this mysterious QE? In a nutshell, it's when a country's central bank, like the Federal Reserve in the US, injects money directly into the economy. Think of it like a financial IV drip, except instead of saline, they're pumping in billions, even trillions of dollars. They do this by buying up bonds and other assets, mostly from banks. The goal? To get those banks lending again, lower interest rates and boost spending. Because when people spend, businesses grow, and the economy theoretically gets back on track. Sounds simple enough, right? But there's more to it. The reality is, this process can lead to unintended consequences. For instance, it can create asset bubbles, where the prices of stocks or real estate skyrocket beyond their actual value. And when those bubbles burst, it can lead to financial crises. So while QE aims to stabilize the economy, it can also introduce new risks. It's a delicate balancing act, and central banks have to tread carefully. The stakes are high, and the outcomes can be unpredictable. So, next time you hear about quantitative easing, remember, it's not just financial jargon, it's a powerful tool with far-reaching effects. And as we navigate this economic roller coaster, it's crucial to understand both its potential benefits and its risks. Hold on to your hats, folks, because this ride is just getting started. Welcome to Novum Tempus, your go-to source for the topics that matter. Today we're exploring quantitative easing. What does it really mean? Is it a lifesaver or a ticking time bomb? Let's unpack it together. Share your thoughts in the comments and join the conversation. Imagine the economy as a giant, wheezing, coughing mess. It's 2008, the financial crisis is in full swing and everyone's running around like chickens with their heads cut off. Enter quantitative easing, the experimental drug that promises to cure all that ails us. Okay, maybe not cure, but at least stop things from getting worse. See, when an economy is in a recession, people tend to panic. They stop spending, businesses tighten their belts, and banks become stingier than a squirrel hoarding nuts for winter. This creates a vicious cycle where things just keep spiraling downwards. That's where QE swoops in, cape billowing in the wind, metaphorically of course. By injecting money into the system, central banks hope to jumpstart lending, encourage investment, and get the economy moving again. It's like giving the economy a strong dose of caffeine, a temporary jolt to help it pull through. So, did this risky maneuver actually work? Well, the jury's still out on the long-term effects, but in the short term, QE did seem to provide some much-needed relief. Think of it like giving a tired kid a sugar rush. It gives them a burst of energy, but it's not exactly a sustainable solution. After the 2008 financial crisis, countries that implemented QE, like the US, UK, and Japan, did see some positive results. Interest rates stayed low, borrowing became cheaper, and stock markets rebounded. This, in turn, boosted confidence, which is crucial for getting people spending again. Of course, correlation doesn't equal causation, and it's impossible to say for sure whether QE was the sole reason for the recovery. But there's no denying that it played a significant role in preventing a complete economic meltdown. Inflation Nation. Are we paying the price? Now for the downsides, let's dive deeper into the consequences. Remember that sugar rush we talked about? The initial high feels great. Well, what goes up must come down, and in the case of quantitative easing, that down often comes in the form of inflation. It's like a roller coaster ride that ends with a sudden drop. You see, when you pump a ton of money into the economy, it's a bit like handing everyone an extra $100. More money in circulation can lead to higher demand for goods and services. Sounds great at first, right? People are happier, spending more, and the economy seems to be thriving. But here's the catch. If everyone has more money, everything becomes more expensive. Prices start to rise across the board. That's inflation in a nutshell. It's a hidden tax that affects everyone. Suddenly, that cup of coffee that used to cost $3 now costs $5, making everyday items less affordable. And that loaf of bread, it's no longer a simple purchase. Well, you might need to take out a second mortgage just to keep up with rising costs. Financial stress becomes a daily reality. This is one of the biggest criticisms of QE, that it devalues currency and erodes purchasing power, making your money worth less over time, especially for those on fixed incomes or with limited savings. They feel the pinch the most. It's like playing a game of hot potato with a ticking time bomb. Eventually, someone's going to get burned. The long-term effects can be devastating. The rich get richer QE and the widening gap. And who usually ends up holding the bag when inflation rears its ugly head? It's the everyday people. The ones who are already struggling to make ends meet. Yep, you guessed it. The little guy. The hard-working individuals who don't have a financial safety net. See, while QE might have helped prop up the economy, it also exacerbated existing inequalities. The rich get richer, and the poor get poorer. Remember how central banks buy bonds and assets during QE? This is supposed to inject money into the economy. Well, who holds most of those assets? It's the wealthy investors and large corporations. Not your average Joe, that's for sure. The everyday worker doesn't see much benefit from these asset purchases. We're talking about wealthy individuals, corporations, and financial institutions. They are the ones who benefit the most. So, when asset prices go up, thanks QE, it's the already wealthy who reap the rewards. Their wealth grows exponentially. This has led to accusations that QE is nothing more than a giant wealth transfer scheme, enriching the 1% at the expense of everyone else. The disparity is glaring. And it's hard to argue with the numbers. Wealth inequality has been steadily increasing in many countries that implemented QE, leading to social unrest and a sense of economic injustice. The gap continues to widen, sparking debates and protests worldwide. Experts divided: is QE a magic trick or a disaster in the making? So, is QE the economic savior it's often portrayed as, or a ticking time bomb waiting to explode? Ask 10 economists and you'll likely get 11 different answers. The truth is, there's no easy answer. Some argue that QE was a necessary evil, a last resort to prevent a catastrophic collapse of the global financial system. They point to the short-term benefits and argue that the risks of inflation and inequality were outweighed by the potential consequences of doing nothing. Others are far less optimistic. They see QE as a dangerous experiment, a band-aid solution that merely postpones the inevitable while creating a whole host of new problems. They worry about the unintended consequences like asset bubbles, moral hazard, and the erosion of central bank independence. The final verdict, you decide. So there you have it, folks. Quantitative easing, a complex, controversial, and potentially catastrophic economic policy. Is it a lifesaver or a ticking time bomb for our economy? The answer, as with most things in life, is it depends on various factors. Ultimately, it's up to each individual to weigh the evidence, consider the arguments, and come to their own conclusions. Because one thing's for sure, the debate over QE is far from over, and its effects will continue to be felt for years, if not decades to come. Thanks for tuning in. At Novum Tempus, we're dedicated to shedding light on the topics they try to keep hidden. Until next time, keep questioning, stay curious, and keep exploring. We'll see you in the next one.